From New York City for our viewers worldwide, I'm Dani Burger, in for Jonathan Ferro. It's the last piece of the puzzle before the Fed. PPI comes in hotter, retail sales weaker, another round of choose-your-own-adventure data that sends yields up with large-cap stocks holding on to their gains. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, markets are digesting a busy day of U.S. economic data. Retail sales, they missed the mark, while another inflation print comes in hot. It fuels concerns that the Fed may be in no rush to cut interest rates. We begin with a big issue. All eyes on Chair Jay Powell.
If there's an upside risk here to the projections for next week, it would be to a little bit higher inflation and, maybe the median dots shifting up as well. But, in general, I wouldn't expect huge changes from the statement next week or from what Chair Powell says in his press conference relative to what they've been saying recently.
Let's break down those numbers and get to Bloomberg's Mike McKee on this. Mike, it's something for everyone, basically, in this data.
Well, not necessarily for those who think the Fed should be cutting soon because inflation is a little bit hotter. Remember, Jay Powell said, we want to see continued progress. Doesn't have to be better each month. But he didn't mention the fact that it could be worse, and that's what we got with PPI. It was up 0.3 in January, up 0.6 in February, and the year-over-year rate goes from 0.9 to 1.6%, definitely going the wrong direction. The supercore rate there, 0.6, only 0.4, but on a year-over-year basis goes up to 2.8%. So this is not something to write home about, and I'm sure it will get talked about at next week's Fed meeting. Retail sales, meanwhile, a little bit weaker than expected. They had fallen in January. Most people attributed that to weather effects and expected a rebound, but the rebound is smaller than anticipated, just up 0.6 instead of the forecast 0.8. And the control group, the part that goes into GDP, just 0.0, flat on the month. We'll look for a revision there because those numbers are generally heavily revised. Maybe the story of the day, though, is jobless claims. The labor market we all thought was getting a little bit looser, but then look what happens. We go to 209,000 jobless claims, down from 210. This is like a 4-week low here. Continuing claims also falling. Although the previous week was revised much, much lower, it looks like people are getting jobs at this point, and the idea that people were losing their jobs and not finding new ones getting harder to sell. Let's take a look at the PPI from the inside, some of the movers that we care about. The interesting thing about PPI for economists and for the Fed is a lot of it feeds into their indicator, the PCE, including in portfolio management, which was up over 5% in January, but only 0.2% in February. Health and medical insurance, though, up quite a bit, 1.4% during the month. I threw in eggs. It's not a big deal, but we know about a year ago this was a big deal. Yeah. Everybody complaining about the price of eggs. They go up 55% at the wholesale level. Quite interesting. Diesel fuel up 15.9%. This could be an issue for truckers going forward, and that could be an issue for shipping costs. We did see gasoline prices rise as well, but this is the first big jump that we have seen in diesel prices. Retail sales, a lot of weakness pretty much across the board. Grocery stores down 0.1%, clothing stores down 0.5%. Building materials, one of the bright spots, up 2.2%. Rebound there because construction could continue with the weather getting better. Food and drinking places, the only services in the numbers, up 0.4%. It's the one number in there that tells you maybe things are not all that dire. People still going out for a good time. But it's interesting. This was not the rebound effect in the retail sales numbers that we expected.
Yeah, I refuse to go back to the days where eggs are a luxury. I just refuse to do it. Mike, thank you so much. Michael McKee. All right, let's get to the conversation now with Nuveen's Saira Malik and HSBC's Max Kettner. Here we have again, we keep learning the lesson that the labor market is stronger or not as weak as we expected, and that inflation is coming in hotter. Max, we'll get to the market reaction in just a moment, but we had Tuesday a CPI upside surprise, Thursday's PPI upside surprise. What does this change, if anything, for the Fed next week?
I don't think for the Fed next week it changes a lot, right? It might be at the margin a little bit more hawkish. But, you know, in terms of perhaps the Fed, but also in terms of what the market thinks, look, as long as we're still on track for rate cuts, I don't think if you're long equities at this point, it doesn't really matter whether they cut 2 or 3 or 4 times, whether they start cutting in May or June, or possibly only in September. That's not really the big deal breaker. I think the big deal breaker would be if you go from, you know, sort of 2 to 3 cuts towards 1 more hike, right? If suddenly they're starting to change their tune really dramatically, a little bit like they did last September. Remember, where all of a sudden, out of the blue, they were saying, hey guys, we need to hike another 1 time in December, right? Where they suddenly put another hike in the December dot plot. And the bar for that, for the Fed to do that, to move from cuts towards another hike is extremely low, right? Whereas the bar to cut, whether it's 1 or 2 or 3 times, is really low. So I don't think it changes a lot.
Sarah, would you agree with that? That even if this does change, you know, 3 dots to 2 dots, that's not what matters? It's that cutting bias that matters?
I think Max's view that could we come well under when it comes to rate cuts and even move towards maybe no cuts or a hike, I think that view is not off the table for the Fed. Really, there's a battle here between inflation and the consumer. And right now, inflation's winning the battle. We're seeing the consumer continue to weaken. And the Fed has been pretty clear. They want to see broad disinflation before they start cutting interest rates. We're not seeing that yet. We're seeing a pickup in goods. We're seeing continued shelter inflation. And of course, the employment market remains very strong. They've mentioned they would like the employment market to crack, and we're not seeing that at all either. You know, my concern is the consumer here. Month 2 of poor retail sales. January was not an anomaly. The consumer is starting to weaken. We're seeing that with higher delinquencies. That is an issue, but I don't think we're going to get into rate cuts. Certainly not next week. Will we start this summer is still out there to be seen. And could we go past the election without a cut and eventually, if inflation is sticky, see a hike in front of us? I don't think that's off the table.
Well, Max, again, I know you think, look, going from 3 to 2, whatever cuts doesn't really matter. But what about next year? What about 2025? We still have plenty of cuts penciled in this market. What if this hot data means that we're going to a soft landing if we also have a still strong labor market and we get no cuts in 2025? It's something like Bostic talked about, 1 and done. Does that change things?
Yeah, I think that does change the thing, right? Like that does really change the debate. Look, I guess here's the thing. When we look at, for example, what's happening over the next couple of months, most likely. Look at, for example, Q1 earnings expectations from consensus. They're flat quarter over quarter, right? So even for tech, earnings expectations are flat from Q1 compared to Q3. So it's very unlikely, right, that we're going to get, for example, a really bad earnings season. So that should be keeping us pretty strong on equities. But on the rate side then, right, for rates really to matter for equities again, we need to have rates vol going up, right? It's not enough to see the long end going up. It's not enough to see nominal yields picking up. We need to see interest rate volatility go up. Look at the last 2 years. When multiples came under pressure, it was really not really the yield move. It wasn't the absolute nominal yields or real yields or the term premium. It was really when interest rate volatility, and particularly at the back end, was picking up, that we really saw some pressure on multiples starting. And that is still a bit off, I think, right? Like at the moment, we're seeing sort of a gradual rise in yields.
I was
So
going to say,
me,
Max, is that why we're not seeing more of a reaction in equities in a day like today where yields are picking up 4.5 basis points and futures are still up 0.2%?
In my view, 100%. I think you're spot on, right? And in my view, it is exactly this absence of interest rate volatility or a pickup in any kind of interest rate volatility that is keeping, you know, the sort of the multiple expansion alive, that is keeping the spread compression in IG credit and high yield credit alive, right? So the better trade right now from an asset allocation perspective is to actually at these levels still remain underweight in sovereigns and overweight in equities, overweight in high yield in our view, right? The trade to be done, I think, is sort of playing a little bit the reversal in the rally in rates that we had up until this week, right? To play a little bit that reversal against equities and against high yield. That is the better thing to do right now. But you're absolutely right. I think next year that's a more interesting trade, right? We could be, I think it's an entirely feasible scenario that we are, like Saira was saying, that we are going into a sticky inflation picture, that where inflation is picking up a little bit perhaps, and then we're going into next year, the Fed starts to cutting maybe 4 or 5 times, and then they realize, actually, maybe we have to pause at 4.5 or 4%, right? And then that could be leading to a pickup in rates vol, and that then could be really putting a bit of pressure on multiples.
Well, that'd be unfortunate because then we'd miss the wonderfully bullish equities Max Kettner we've had for 2024. I'm starting to enjoy him. Saira, I wonder what you make of that, because I know you list as one of your headwinds for stocks higher 10-year yields. And that's exactly what we're seeing. Yields picked up before today, some 30 basis points. We're adding another 4 to that this morning, yet equities are behaving. At what point do rates start to impact equities again?
I am worried about where 10-year yields are trading. They're well up above 4, crossing 4% here. And also another thing I'm worried about is election year volatility. We have 77 countries going to the polls, 60% of GDP voting. We know that in election years, markets tend to be more volatile, and the closer and less predictable an election year is. And with AI and misinformation out there, I think this is going to be one of those years with a lack of predictability around the elections. That's going to lead to more volatility for the markets. The two things holding up the markets here are basically employment markets and the economy. And of course, let's not forget earnings. So what we're seeing is the market has been broadening out in terms of returns, but I question whether that's sustainable, because if you look at fourth quarter earnings, which Max did mention, it was very tech heavy. Tech led earnings by about 15% revenue growth with the mega cap stocks and 60% earnings growth, while the rest of the S&P 500 was pretty weak, around slightly positive revenue growth and somewhat negative earnings growth. So we're not seeing that participation from earnings growth from the other 493 companies. It's unclear to me if we can get there given where interest rates are. And that's what concerns me about this market. It's trading at a premium. We're seeing some broader participation. It's not clear to me that that's going to be sustainable because the earnings just aren't there for the other companies to drive the markets higher from here.
Right. Saira, Max, you're going to stick with us. We have much more to discuss. In the meantime, though, let's look at some of the stocks that are moving ahead of the opening bell. With that is Abigail Doolittle. Hey, Abby.
Hey, Dani. Well, let's start out with the shares of Robinhood because they are popping sharply higher. This after they gave an update on February operating numbers. Data was very strong. Crypto in particular, the stock up 11%. We also have Bernstein initiating with an outperform, saying that the company will benefit from a quote-unquote monster crypto cycle. Dollar General, in sharp contrast to Dollar Tree yesterday, up about 5%. Their same-store sales came in better for the quarter that was on strength in consumables. The same-store sales forecast is better, of up 2 to 2.7% versus the up 1.4% estimate. Apparently, growth in traffic and market share gains are really helping out. U.S. Steel, after plunging 13% yesterday, down another 5% in the pre-market after President Biden says that this company should stay American-owned and operated, basically coming out against that Nippon Steel potential takeover, the Japanese company. Perhaps more drama ahead there, Dani.
Oh, joy. Abigail, thank you very much. Okay, coming up on the show, we're going to get more insight, or we have more insight, and we're going to dig into it to the U.S. consumer.
When we look at the state of the consumer, when we look, say, at net household wealth in the US, it's making new all-time highs in itself, $156 trillion.
Retail earnings continue rolling out. We're going to break down the latest results for you next. This is Bloomberg.
When we look at the state of the consumer, when we look, say, at net household wealth in the US, it's making new all-time highs in itself, $156 trillion. And obviously, you've got positive real wage growth also helping the consumer.
Investors are digesting a host of U.S. economic data. PPI came in hot, but a downside surprise in retail sales. It comes off fresh retail earnings this morning. We had Dollar General and Dick's Sporting Goods. Both reported sales that top forecasts, suggesting that consumers have kept spending on essentials, but they continue to be selective. Joining us now to break down that selectivity is Bloomberg's Simone Foxman. Hey, Simone.
Hey, Dani. Yeah, back to that retail sales data. It may really be bearing out what companies have been telling us all quarter. They've been offering a bit softer guidance for the year, especially in the first quarter. And so that 0.6% rise in retail sales, even less when you cut out gas and autos, may be indicative of that. We saw spending falling at furniture outlets, health and personal care stores, clothing, and e-commerce. Target's CFO said last week disinflation is the name of the game in retail this quarter. If you look at those earnings out today, they're following that narrative so far. Dollar General and Dick's Sporting Goods, as you mentioned, beating expectations, but maybe Wall Street had kind of downgraded its hopes going into these earnings as we get into the last earnings of the season. Dollar General expecting its first quarter to be the weakest of the year, but its fiscal year outlook topping expectations, with comp store sales expected to be up 2 to 2.7%. Dick's also beating on its top and bottom line in the fourth quarter. Fiscal year also seeing comparable sales up 1 to 2%. The expectation had been on the higher end. However, we'll also carefully be watching Ulta Beauty. It reports after the close its full year, its expectations for the full year is expected to be the lowest since 2021, but it's been in positive territory for such a long time. Maybe the end of that post-pandemic revenge spending, Dani.
Simone, thanks for walking us through that. Bloomberg's Simone Foxman. Now, one contour of this American consumer has been the unevenness of it. McDonald's CFO Ian Borden weighed in on this, exactly what they're seeing, that consumers are working through dealing with all the inflation. Higher interest rates are having an impact, and this is key here for lower income consumers. You've got a couple of additional dynamics: eroded COVID savings that people were drawing on and spending from that are largely gone. He was speaking at a UBS conference yesterday. Saira Malik and Max Kettner are still with us. Sarah, we know that this recovery, that this growth coming from a consumer has been uneven. We're getting more warnings yet again about the lower end of the consumer. But at what point, if at all, does uneven growth mean unsustainable growth?
I think consumers are finally starting to feel the pain of higher inflation and higher interest rates. We've seen that for a while with more delinquencies on auto and credit card debt. That's finally now starting to run through. So what's left to hold up this economy? Strong employment markets, which so far we can count on, are important. But going back to the Fed of what they're going to do, I just don't think we're going to see rate cuts anytime soon. Even just looking at this week's CPI and PPI data, some of these numbers that flow through to PCE, which is the Fed's preferred barometer of inflation, like airfares and also auto insurance and healthcare, those are all up quite significantly within the numbers that we've seen. I think that bodes well to a PCE that's going to come in hot again. And that, again, kicks the can down the road for the Fed in terms of cutting interest rates. And going back to the consumer, that's a headwind for the consumer that's going to continue month 2 of poor retail sales. We may be seeing more of that with consumers pulling back.
Right. So, Sarah, if we're in this environment where the Fed isn't going to cut, the consumer is under pressure because of higher rates, they continue to be under pressure. What does that mean to asset allocation, specifically in stocks? Do some of those consumer names start to become less attractive?
Well, given that the broad S&P and also mega caps are trading at a premium, I think overall stocks are expensive. And so it's time to pull back and become a little bit more defensive when you're looking at equity. So we like areas like infrastructure, which is a cross between equities, public, and also real assets. That segment tends to be more resilient during an economic downturn. Also, it has contracts in place to pass through inflationary pressures. We like companies and sectors like that in this kind of turmoil and volatile period. Dividend growers, another area where you can get income. These companies tend to grow their dividend over time. And during down markets, dividend growers tend to perform better than the index tends to do if you look at history. But you get a lot of the upside capture from that, too. I don't want to also just ignore fixed income here. There are higher qualities of high yield municipal bonds that have strong fundamentals. You can lock in yields that you haven't seen in years, sometimes even decades at this point. Right. And during tax selling season, municipal bonds tend to be a buying opportunity.
Going back to the consumer, Max, and I'll let you comment on that call in just a moment, but on the idea of the consumer, we have seen this. We have seen credit card delinquencies, to Sarah's point, above their 15-year average. We have seen auto delinquencies. They're about at pre-pandemic levels. Are you in agreement with Sarah that this is where we're starting to see some cracks or at least some weakness among the consumer?
Yeah, I think we're starting to see some cracks, but I would be not as concerned, I think. I would actually take perhaps, in some aspects, probably the other side of the coin. When we look, for example, at delinquencies, yes, delinquencies, credit card delinquencies as well are rising. But let's remember, they're still way miles below where they were on average before the financial crisis, right? So what we're seeing now perhaps is some of the exuberance that we had in borrowing during the COVID or during the post-COVID era, right, in 2021 and 2022. Some of that taking, or some of that really taking a bit of an effect right now. But I wouldn't be overly concerned there right now, because when we look at other things on the consumer, other stress indicators, look at private household insolvencies. It's the same sort of pattern, right? We're going back to where we were pre-COVID averages, but that was still miles below where we were before the financial crisis. The same thing is happening when we look at, for example, household debt service ratios, right? It's also been rising in the last 2 years, but it's just merely really at the averages where we were before the pandemic and still miles off where we were before the financial crisis. So I wouldn't be as concerned. And I would also stress what we've seen over the last, let's say, year and a half, with equities rising, with even house prices going up again, is a pretty substantial wealth effect for you as consumers. Probably, you as household wealth over the last 4 quarters has probably gone up $13-14 trillion with the rise in equities and in households. That's half a year's worth of GDP, for example, of nominal GDP, right? When you look at the distribution of that, it is actually the lower 20th percentile that's been benefiting from that. If you look at the buildup of net wealth since the pandemic, it's been particularly the younger households, right? Those up to 39 that have built up the most net wealth, the most net real wealth as well. So they are spending actually more money, they're consuming more. So I'd be actually not as concerned and would say, given that, the distributional effects have been favoring a bit more, the lower income households, the younger households, those ones that tend to consume more, in contrast to what we've seen in the 2010s. I'd be a bit more bullish on the consumer, and that sort of cycle can extend a bit further in the next couple of quarters.
And that is an interesting breakdown between the two of you, because Max, you like risk at this point. Saira, you're more skewed towards that fixed income, taking some of the equity off the table, perhaps. Saira, I just want to get your reaction to that perhaps things aren't so bad and we can stay in risky assets. I mean, the appetite in the market is certainly there when you look at things like credit spreads for triple Cs at a 2-year low.
Yeah, I think Max makes a good point. Is the appetite there right now? It is. You look at equity market valuations, though, they're trading at a premium versus history. His sort of threat on the consumer tends to feel pretty comfortable as long as employment markets are strong. So that's what we have to hang our hat on in terms of, can the consumer continue from here? I'm worried about the second derivative here. We are starting to see these delinquencies picking up. We're seeing inflation that's sticky and a market that's at a premium. So that's where it becomes concerned. How much do we want to pay for what we have going forward, not for what's happened in the rearview mirror? I think going forward is risky, also with the 10-year above 4% and election year volatility, which tends to pick up. That makes me more nervous for the rest of the year. But remember, we came into this year expecting 7 rate cuts. That was what kicked off this rally. Now we're down to 3. If you ask me, will I take the over-under on 3? I'll take the under on 3 because I think inflation is going to be sticky for a while. Having said all that, do we want to pay these valuations for this market? I think it's becoming much trickier from here.
Okay, well, luckily we can settle this with the dots next week. Saira, Max, really appreciate your time. Saira Malik and Max Kettner there. All right, SpaceX is getting ready to launch its test of the Starship rocket this year. It's the first of this year. It's the third. You're looking at live pictures there in Boca Chica, Texas, with the spacecraft atop of the Super Heavy booster. Let's get over to Bloomberg's Ed Ledlow, who joins us now, who's been looking at this. Ed, this is just a colossal rocket here, getting ready to take off.
Yeah, it's the biggest launch system ever built. It's the most powerful rocket ever built. And as we approach 25 seconds till liftoff, it looks very good that we're going to proceed with this. There had been a hold at the T-minus 40-second mark just to check out the wind. Let's listen in to the countdown.
T-minus 10, 9, 8, 7, 6, 5, 4, 3, 2,
30 seconds into flight, we are feeling the rumble. We are seeing 33 out of 33 Raptor engines ignited on the Super Heavy booster.
Booster and ship, avionics, power, and telemetry nominal. Acquisition of signal, Corpus Christi.
Continuing to get good call-outs. Our trajectory looking nominal, systems looking nominal. Just amazing to see all 33 lit up once again. At this point, we've already passed through max Q, that maximum dynamic pressure, and passing supersonic, so we're now moving faster than the speed of sound. Getting those.
Okay, so Starship, Dani, has reached the moment of max Q. That's the moment of maximum aerodynamic pressure on the combined system. The top half, the pointy bit Starship, the bottom half, the Super Heavy booster. SpaceX would tell you that whatever happens over the next 8, 9, 10 minutes will be its success. This is all about gathering data and making incremental progress. But the ambition here is at the 2 minutes 45-second mark-ish for the booster's engines to cut off, and then shortly after that have a hot staging where basically the Super Heavy booster and the Starship craft will separate with a controlled burn. Then the 6 Raptor engines at the base of Starship, which are insulated by a heat shield, they will ignite and the Starship will carry on its trajectory while the Super Heavy booster then starts a controlled free fall back down into the Gulf of Mexico. And we can get into some of the process, but what you're seeing, that's success right now. How far they get into their stated mission goals, we'll have to see.
What does success mean for SpaceX as a company with this mission specifically, Ed? Because this thing is the cash cow of them, right? I mean, here you have, as we were saying, this big starcraft, this big Starship, I should call it, that can fit a lot of cargo, fit a lot of things in it. So what does it mean for the commercial viability of SpaceX?
The maximum payload capacity of Starship is about 100 to 150 metric tons. As you see there, I think the Super Heavy booster falling back down. I'm just going to check. We've had stage separation successful, I'm just reading. So now Starship's continuing on its journey. This ain't easy, by the way. SpaceXV, talking to Bloomberg's Dani Burger, doing all the same time.
Tested
but the point is, you're exactly right, that the investors, our global audience, care about the economics of what SpaceX is doing. Starship can carry more stuff. That means that they can build out the Starlink constellation more quickly. That generates higher degrees of revenue. It gets them to more sort of solid ground on cash flow break even, and that funds the bigger picture goal for Starship, which is to carry humans to Mars in the long term, but in the short term to the moon in the first instance.
Well, there's this huge push for the moon, and Ed, we've seen that kind of be successful, kind of not successful in some cases. Last month we had Odysseus, that private U.S. lunar lander that, you know, yay, it lands, and then it kind of goes like this when it lands and collapses and doesn't quite work as planned. I mean, it's this huge space race, but this time it has the private bend to it. With each sort of venture like that that doesn't go quite as planned, what does that mean? Again, in this time where things are speeding up so forcefully.
Well, SpaceX and NASA are intimately tied on this goal of returning humans to the surface of the moon, right? I forget the year. It's been an early morning for me, but it hasn't been since the 70s that we've really talked about this idea of getting humans back into space. The first iteration of that is a non-manned, a non-crewed attempt for Starship to land on the surface of the moon. And as part of the Artemis program, then to follow up with Starship being the vessel that might get mankind there. You know, these might sound like sci-fi to a lot of our audience, but SpaceX is building out a program where Starship, because it can carry 100 to 150 metric tons, can take the materials to space and to the surface of the moon needed to establish a base on the moon. And that might sound, as I say, scientific to you, but that is basically the principles to which the Artemis program is aiming.
Okay, Ed, I have the date for you. December 19th, 1972 was Apollo 17, the last time they went to the moon. I
wasn't around then, full disclosure.
I mean, I wasn't either, so it's okay. We're on the same page here. Neither you or I remember the last moon landing because we certainly weren't around. Okay, so let's say we have success here. The commercial viability of SpaceX, it increases whatever fold. what next? What does SpaceX look like as a standalone company? Is it an IPO? Is it something different? What is the future for them?
So in the last tender or secondaries round that SpaceX did, the company was valued about $180 billion. And what I've reported with colleagues is that 2024 is the year where revenue contribution from Starlink outpaces revenue contribution from the launch business. Remember, like, SpaceX makes money from government contracts and private contracts to carry stuff, payload, and human payload into orbit. But really, the money is in Starlink, right? This is a satellite constellation-based internet service where consumers pay a monthly subscription and also a one-time fee for a ground-based receiver. The hope of investors, and it's been downplayed by Elon Musk, is that the Starlink portion is spun off in an IPO. I've reported that the groundwork is underway. Starlink is being moved into its own separate legal entity, a standalone company, if you like. And there is some thinking that 2025 is possible when it comes to a Starlink spin-off. Musk has really downplayed that because, one, he has no problem raising capital from the private markets, but also, two, sorry, I'm just taking a look at my screen, and that is the booster, super heavy booster, falling back down into the Gulf of Mexico. What they're going to try and do here, Dani, and sorry, I know I'm going on here.
No, please
what
do.
they're going to try and do is they're going to simulate the landing process of the super heavy booster, do the controlled burns to right it, put it the right way up, but they're still going to crash it into the Gulf of Mexico. They're not going to try and recover any of the hardware here. And final point in the space IPO, investors would love a piece. Elon Musk's basic point has been, I'm not going to spin off that Starlink unit until I have clear visibility on positive cash flow, which sounds a very sensible and prudent thing from Elon Musk, who is not often sensible nor prudent.
Yeah, and Ed, you know, I'll let you have a moment here just to kind of look at everything and make sure everything's going to plan with that rocket launch, because I know it's a lot to keep track of from, you know, my own amateur eyes. At least what we're seeing so far perhaps looks like it's gone to plan. I know you were saying that one piece was coming down. They're okay with crashing it into the Gulf of Mexico. So Ed, it would be great to get an update from you just where we are at the moment. But secondary to that, I know each of the prior launches did end up with pieces of the Starship blowing up, and that led to an FAA investigation about their systems and environmental impact. So when it comes to regulatory impact, what could we see from this, whether it goes to plan or not?
So we are at the 8-minute mark. The Super Heavy booster, we've had confirmation, did splash down in the Gulf of Mexico. After the fact, there will be an investigation on how successful the process of simulating the booster landing was. What I think we're looking at now, and you hear cheers from the SpaceX staff, is that Starship's 6 own Raptor engines have now shut off. And what represents progress in this mission is that they will try later on to reignite the boosters on Starship, which has not ever been done before. What we're looking at in real time is just astonishing technological progress on what's happening. This is the 3rd attempt to get the Starship system into space. This last time what happened is that they got to an altitude of about 150 kilometers, traveling at a speed of 24,000 kilometers per hour, which is about 15,000 miles per hour. And there was an anomaly which the automated system detected, and then basically the Starship self-destructed, for want of a better description. It has not done that so far. They keep going, and there are a number of tests that they want to do while Starship is in space. They've gone through the ascent burn of both stages. What they want to do is try and experiment by opening and closing the payload door. So we talked about how Starship can carry 100 to 150 metric tons. Basically, in the context of Starlink, there is a little slot at the top of Starship. And in the future, to deploy those satellites, I'm relying heavily on my hand movements here, but they'll just come out one by one, just like that. So they want to practice the current design of that payload door. That would be a huge success. And then, as I said, one success point would be to reignite the Raptor engines. I don't think they've done that yet, though I'm looking for confirmation. It's already surpassed the length of those 2 prior tests. So this is astonishing technological progress we're looking at.
Yeah.
And then the final test, well, what I'll leave you with is, if we're ever going to get to Mars and indeed the moon, it's one thing getting Starship into Earth's outside of Earth's atmosphere and into orbit, but you're going to have to refuel. What that looks like to SpaceX's mind is having 2 Starship spacecraft in orbit. One of them will be a fueler, a loader, full of propellant. They will dock in space, on paper, in theory, and the refuel process will happen in space. So an element of what they're going to test today is that refueling process. And I think because we only have the downward-facing camera, and I'm speaking over the SpaceX feed, it's going to be hard for us to know progress until after the fact.
Right.
But we're doing a pretty good job 11 minutes into this launch.
Hey, Ed, I'd say you're doing a pretty good job. Let's be clear where the legwork is coming from. But I want to get back to this idea of the FAA investigating SpaceX for the prior rocket ships blowing up because of pollution. The New York Times had this great story to start the year, basically saying that there was a study in 2022 that said if the rate of rocket launches increased by a factor of 10, and so far they're increasing quite rapidly, their emissions could cause temperatures in parts of the stratosphere to rise as much as 2 degrees Celsius. Ed, of course we have to celebrate the technological advances that are coming from this rocket-type launch, but how do we balance that with the environmental impact?
Yeah, I mean, one of Elon Musk's rationales is that long-term, the continued existence of the human race depends on us being an interplanetary species. So acknowledging the risks of long-term climate change on the planet Earth, that's his kind of big picture goal. But we're talking well beyond your and my lifetime, Dani, well beyond. I think that's the big picture. But the reason that after the last 2 tests, Test 1 and Test 2, authorities investigated the near-term environmental impact is simply that the explosion propels debris across a wide range of area, right? The test launches are highly controlled. It's why the FAA has to issue licenses. And in the Boca Chica area, the environmental impact of that debris and the byproducts from combustion are assessed, literally in terms of the impact of the wildlife, flora and fauna in that area. But you also have to acknowledge that these tests are tightly controlled, right? The airspace in and around Boca Chica and Starbase, heavily controlled. One of the reasons we were slightly delayed this morning is that there were boats in close proximity in the Gulf of Mexico, and they had to kind of be shooed away. All of this is kind of normal procedural stuff, although it's also important to acknowledge SpaceX would like to move much more quickly than they are, and one of the limiting factors is the authorities doing investigations such as these.
One thing I think is important to point out, we're looking right now at the control room. I seem to have noticed some green hats there, and I think someone had a 4-leaf clover on the back of their T-shirt, so it looks like it's
St. Patrick's Day.
Yeah, I was going to say, I think it's a St. Patrick's Day kind of launch, so hopefully they get some of the luck of the Irish and things going as planned. Ed, going back to the Odysseus moon lander that had not exactly a crash landing, but not exactly a perfect landing, I mean, is there any real competition for SpaceX, for private space at this point in terms of advancement and just the amount of testing and these types of launches that they've been doing?
No, not if your criteria for success is judging ability to take payload, either human or non-human, to orbit and beyond. You will have seen the other big story in the space industry this week was Japan testing its solid fuel-based rocket, which exploded pretty shortly after liftoff. The reality is that SpaceX accounts for the vast majority of payload to orbit. In other words, and in layman's terms, SpaceX does most of the launching, putting stuff into space. There are others that are trying to catch up. Rocket Lab is a publicly traded example, but Rocket Lab is nowhere near the stage where it could carry humans, as an example. Then you have the kind of legacy aerospace names, United Launch Alliance, Boeing, et cetera, and the work they're doing, and they're nowhere near.
All right, Ed, we're going to leave things there as they go through the rest of this test flight. Thank you so much for that. That is Bloomberg's Ed Ludlow. Again, SpaceX Starship has launched into space. It's already surpassed the length of the prior 2 tests. So far, success for Elon Musk and SpaceX. This is Bloomberg. About About 13 minutes into your trading day, this is the state of play. Stocks are resilient against the face of hotter than expected PPI after that hotter than expected CPI earlier in the week. NASDAQ outperforms up 0.3%, while small caps, they cannot hang. If we're looking at less cuts this year, perhaps that's where the pain is. Those are down 0.5%. But stocks are also moving higher in the face of higher bond yields. Check out what's happening across the curve. We're moving up by as much as 6.5 basis points for the 10-year yield. This is now the fourth consecutive day of higher yields. It is the story of inflation peaking up more than we had expected and what that means for the Fed's trajectory. But again, there is a split here between how bonds are reacting. Again, we're at 4.25 on your 10-year yield and higher large cap stocks. Now, to try to get out why there's that difference, JPMorgan's Jack Caffrey has been summarizing the market over the past month, writing that equities are likely to be supported by good economic news overall, as good news supports estimates. Bond traders are likely to think the good news is bad news, and they're pushing out their slowdown in estimated Fed cuts. Pleased to say that Jack joins us now. Jack, so wonderful to see you on the program today. And that is just the perfect encapsulation of what's happening today, because bonds are in pain and stocks are not. So is that what's going on, that stocks are okay because maybe this is good news?
Well, I think, if we try to dig into today's economic news, we will wind up seeing hotter PPI. Hotter PPI is some companies' costs are higher, but one company's cost is another company's revenues. And I do think that stronger revenue burn, if you will, or continued growth winds up actually being supportive of estimates. Companies went 20 years without really having to look to the pricing lever. They now have it. I think they're going to be a little bit slow to give it up. And to the extent that is the case, then the fixed income markets have to recalibrate what they think about. And at some point, we will wind up with a little bit more of a tug of war between the higher certainty of fixed income versus the prospect of better earnings growth to go forward.
We were speaking with Max Kettner of HSBC earlier in the program, Jack, and he basically said that the reason that stocks aren't reacting is because, sure, rates have been slowly moving up, but it's been a slow burn higher, and it's not volatility. But if rate volatility were to come back, then you'd get a reaction from equity markets. What do you make of that?
I think that ultimately the linkage that we're going to see, because the two markets' volatilities look disconnected. Equity volatility is plumbing post-pandemic lows as though there's nothing to worry about. Don't worry, be happy. And that there'll be no liquidity concerns if we change our minds. If you look at fixed income, though, implied rate volatility is running twice the levels we saw before the pandemic. And so you dig into that. There's so many bonds out there with still very low coupons. The math is that bond prices have to be more responsive to those changes. If the change is slow, we can calibrate and things can move forward. But if there's a shock, if you will, likely we'll see yields spike. Yield spiking will probably then work its way back, leading into some concerns in the equity market that, that higher yield eventually creates a hurdle that equities can't surmount, and people might be more comfortable buying bonds not to say we're going to see a 5% 10-year, but you have to start thinking the possibility of that becomes more and more likely every time the yield of the 10-year backs up 1 or 2, 3, 4, 5 basis points. I'm just not sure where that break is, but equities right now certainly are happy having the pricing power and being able to try to use it.
I love what you write, Jack, that we had this environment before the pandemic when corporates benefited from efficiency. Then we get higher inventories. They don't get that efficiency, but they get that pricing power. This all ties in with exactly what you've been saying, Jack. So if we are on a trajectory where inflation is coming down, efficiency still being worked through, where do corporates squeeze that growth from?
To some extent, it's the corporate sector has to start looking to more capital spending in order to try to find that next layer of efficiency. If we think back to the 2000s to 2010, corporate sector could certainly find efficiency by outsourcing production to lower wage regions. To the extent we talk a lot more about nearshoring, friendshoring, the excitement around AI and making things more efficient, I think ultimately companies are going to have to spend money today to become more efficient into the future. I think that ultimately winds up being productive in two ways. One, it's more workers getting paid more in the United States if you nearshore or onshore that capacity. And second, that capital spending tends to be nicely profitable for other companies. So I do think you can create a bit more of a virtuous cycle rather than cut your way to prosperity that worked well for 20 years towards maybe now spending your way towards prosperity and balancing how disciplined you are around that spending, a little bit for the company, hopefully a little bit for shareholders in the way of dividends and buybacks.
Jack, we have to go back to what's happening with duration right now because this is a significant move, 7.5 basis points higher when it comes to the 10-year yield. That's the biggest move since we had the CPI surprise of last month of February 13th. We're going to get the Fed next week. All it will take, this has been written at maybe by ad nauseum so far over the past few days, but all it takes is for two voters to change their dots, to shift their dots lower, to shift the overall median of this dot plot. If that is indeed what we get next week, what sort of recalibration needs to take place in this market?
Well, I think the fixed income market's been trying to get their handle around the good news is actually, equity's good news is bond market bad news. And I think they've so far managed to do that on a very measured basis, looking to, if you will, the shifting forward guidance and the forward guidance following the data. It's been a very data dependent market in that regard. Again, I come back to what does it take for the bond market to suddenly say, oh, it's 2. And I don't think that will be necessarily as problematic as continuing that discussion of, well, what if the next move actually is a hike? That has been sort of a very low rumble out there that I don't think anyone really wants to contemplate, but you hear people talking about it because it's provocative, because we wanted to think that we were done with inflation. The reality is inflation has been a very controlled descent, perhaps a little bit too controlled and taking a little bit too much longer than many people wanted to think. And marginally, I think it remains uncomfortable for the Federal Reserve because I think they would rather not be so much the locus of everyone wanting to talk about who does what, when, why, how many cuts, when will it happen, when do they shift their policy. People want to believe on momentum of policy, and they're not getting that shift that people are looking forward to. But
Jack,
that still said comes back to the reason we're not getting it is because the data's been good.
Yes,
People are working,
and to that point,
more.
Jack, you say that no one wants to contemplate the next move being a hike, but it's clear that, I mean, you say other people are, but it's clear that you are to some degree. The data coming in this way, if it continues, is that enough to shift, again, this momentum to not how many cuts, are there fewer cuts, but is the next move a hike?
I would argue that is ultimately how you take what a market that's been, more or less in less than 3 months, we've generated the return that so many analysts and strategists were talking about getting for the entire year. So it's been a magnificent year in that regard, and it's been a magnificent year without the Magnificent Seven driving it. That's been the good news. And I think within, you're starting to see more companies starting to see their stock prices perk up and start to participate. That all said, the fact that we have come so far so quickly, 8%, 8.5% year to date, 24% effectively over the prior 4 months, we're going to have a bump. And I do think to some extent, some realization around that bump might come more from the bond market, looking at having the time I've been talking, we've seen a 50 basis point reversal in the S&P. So I should probably shut my mouth.
I was going to say, Jack, I think we might have jinxed this because as we're talking about the resiliency of markets, quickly, just only a few seconds here. But
You're killing me, Dani.
But what do you make of that? I mean, this is a volatile market. It's decided to maybe start caring about PPI now.
Well, I would say actually the equity market isn't a volatile market. And in that regard, we've gone 270 days without a 2% sell-off. Not a record, but that's a long period of time, effectively. Yeah. It's a trading year. And so that I don't want to say it's a complacent market, but it's a market that continues to look for the good. It's been finding the good, and it wants to continue to let that effective underpinning momentum carry its way.
Yeah.
You're going to get a blip. And I think the blip probably comes more from the bond market than the equity market right
Jack,
now,
based on 6 years. Mosaic. I mean, it's been the longest streak in 6 years that we haven't had a 2% or more sell-off. I believe that's the stat. Jack, really great to catch up with you this morning. Jack Caffrey of JPMorgan. All right, let's get to the sector price action this morning. With that is Bloomberg's Abigail Doolittle. Hey, Abby.
Hey, well, Dani, with this decline of 0.3% on the S&P 500, we now have most sectors lower, 10 out of 11. Only energy is higher. Real estate, utilities, both down more than 1% as yields go higher. And then relative to some interesting news earlier, we do have the shares of Anheuser-Busch dropping significantly, weighing on consumer staples. And this on the news that Altria sold shares. So volatility is the theme of the day.
Yes, it is. Abby, thank you so much. Coming up, we're going to look at the market moving events. That's next. This is Bloomberg. Let's get to your trading diary. What you need to be watching this week. We're going to get earnings from Adobe and Ulta Beauty later today. President Biden then will participate in a campaign event in Michigan. Tomorrow, we round out the week with the UMich Sentiment Survey, and we also get U.S. Empire manufacturing data. But the theme of this week has been inflation surprises to the upside. It happened with CPI on Tuesday. It happened today with PPI. The impact, yields moving higher by nearly 8 basis points across the curve. Equities turn. S&P 500 down by 0.4%. This was the countdown to the open. You're watching Bloomberg.